Ever wondered what the rich don't invest in? Welcome to a journey into the intriguing world of wealth accumulation, where we'll explore how the affluent approach investing rather differently than the rest of us. We are all striving to grow our wealth, but it's not just about where we put our money, it's also about where we choose not to. You see, the rich and successful have mastered the art of discerning between worthwhile investments and financial pitfalls. They understand the power of strategic investment and the danger of impulsive decisions. Over the next several minutes, we'll be uncovering 7 areas that the wealthy typically avoid when it comes to investing their hard-earned money. From the allure of the lottery fantasy to the trap of non-value stocks, we're going to shed light on these common investment pitfalls. So, if you're curious about what the rich don't put their money into, stick around and let's delve into it. First off, the rich don't invest in the lottery. Now you might wonder why. After all, it's a chance to win a great deal of money, right? Well, that's where you'd be wrong. The lottery isn't an investment, it's a gamble. And the odds? Well, they're incredibly poor. You see, the rich understand that the lottery is a game of chance, not a sound financial strategy. The probability of winning is astronomically low, and the allure of instant wealth often blinds people to the fact that they are more likely to be struck by lightning than to hit the jackpot. Instead, the wealthy invest their money in ventures with a higher probability of return. They put their resources into stocks, bonds, real estate, and businesses. These investments offer a tangible return over time instead of relying on sheer luck. So the next time you're tempted by a lottery ticket, remember that the rich don't play that game. Secondly, the rich don't invest in consumer goods. This might raise some eyebrows, but let's delve into why this is the case. You see, items such as clothes, cars, and gadgets, while they may seem attractive and appealing, actually depreciate in value over time. That's right. The moment you walk out of the store with that new smartphone or drive that shiny car off the lot, their value starts to plummet. Now, this doesn't mean you shouldn't ever indulge in these items. However, it's important to understand the concept of assets versus liability. An asset puts money in your pocket, while a liability takes money out. Most consumer goods fall into the latter category, depreciating over time and consistently costing you money rather than making you money. So before buying that shiny new gadget, ask yourself, is this an asset or a liability? Thirdly, the rich don't invest in high-interest debt. High-interest debt, like credit card debt or payday loans, is a silent wealth eroder. It's like a leech that slowly but surely drains your financial health, leaving you with less and less to invest and grow. The wealthy understand this. They know that every pound, every dollar spent on high-interest debt is a pound or dollar not invested in assets that can generate more wealth. This is why they prioritize paying off these debts and building an emergency fund to avoid falling into this trap in the future. Imagine a bucket with a hole in the bottom. No matter how much water you pour in, if you don't fix the hole, you'll never fill the bucket. That's what high-interest debt does to your wealth. So the key takeaway, pay off high-interest debts as soon as possible and build an emergency fund. Remember, the rich use debt strategically and avoid high-interest debt like the plague. Fourthly, the rich don't invest in get-rich-quick schemes. Now, you may wonder why. Well, these schemes often come with a catch. They are unpredictable, volatile, and usually the risks are hidden behind a veil of enticing promises. Picture this. You're offered a golden ticket to instant wealth. It sounds irresistible, right? But the reality is often far from the dream. These schemes are like mirages in the desert, appearing as a sanctuary, but once you get closer, they vanish into thin air. The risks involved in these ventures are often downplayed or not mentioned at all. It's like walking a tightrope blindfolded. You don't see the danger until it's too late. Moreover, these schemes usually lack a solid business model or a product of real value. They're built on the hope that someone else will pay more for the same promise of rapid wealth. The wealthy know that real wealth is built over time, not overnight. They understand that steady, thought-out investments are the key to long-term financial success. Fifthly, the rich don't invest in things they don't understand. This is a principle as old as investing itself. The allure of quick returns can often blind us to the inherent risks involved in an investment we don't fully comprehend. It's like stepping into an unknown jungle without a map or a guide. Investing based on trends or tips can be akin to gambling. Without a solid understanding of the investment, One can't possibly gauge its potential risks and returns. It's like sailing in uncharted waters where the threat of a sudden storm or a hidden reef is ever present. On the contrary, the wealthy take the time to learn and understand an investment before they put their hard-earned money into it. They do their due diligence, examining the financial health of a business, the market conditions, and the potential risks involved. They don't just follow the herd. They chart their own course based on their knowledge and understanding. The wealthy invest in what they know and understand. Scene script. Sixthly, the rich don't invest in bad real estate. The real estate market can be a gold mine, but it's not just about buying any property that catches your eye. It's about understanding the importance of location and timing. The wealthy know that a property in a prime location, even if it's more expensive, can yield greater returns in the long run. They're acutely aware that real estate is not just about the here and now, but also about future potential. On the other hand, buying property in an undesirable location or at the wrong time can lead to a financial quagmire. The potential pitfalls of investing in bad real estate can be numerous, from low rental yields and high vacancy rates to depreciating property values. The rich avoid these like the plague. They tread carefully, doing their homework before sinking their money into any property. They understand that not all real estate is created equal. Lastly, the rich don't invest in non-value stocks. Now, you might be wondering, what exactly are non-value stocks? Well, these are stocks that might seem attractive due to their sudden spike in price or hype, but they don't necessarily hold any intrinsic value. In contrast, value investing, a strategy favored by the wealthy, focuses on stocks that provide value over time. This strategy involves identifying companies that are undervalued by the market, those diamonds in the rough that are priced less than their true worth. The rationale behind value investing is that the market often overreacts to good and bad news, resulting in stock price movements that don't correspond with a company's long-term fundamentals. The result is an opportunity for investors to profit when the price is corrected. The wealthy understand that investing is not about getting rich quick, but about building wealth over time. Remember, the rich invest with a long-term perspective, focusing on value rather than quick gains. So there you have it. 7 things the rich don't invest in. We've unpacked the wealth paradox and how the affluent navigate it. We've exposed the lottery fantasy for what it is, a pipe dream that rarely pays off. We've dived into the world of consumer goods and demonstrated why they're not a sound investment strategy. We've revealed the insidious nature of high-interest debt and why the wealthy steer clear of it. We've cast a spotlight on get-rich-quick schemes, showing their pitfalls and why they're not a part of a wealthy person's playbook. We've underscored the importance of educating oneself before investing, a principle the rich live by. And we've explored the realm of real estate and stocks, highlighting the difference between value and non-value options. Remember, the wealthy invest wisely, keeping their money moving in ways that generate more wealth. So the next time you're considering an investment, think like the wealthy and make your money work for you.